the right thing to do is get that deficit on a shrinking basis, not an expanding basis, and get our fiscal house in order so it's sustainable. Even the nonpartisan Congressional Budget Office says this can't go on. It's not sustainable. How do you correct it? There are only three ways to do it. One is to reduce government spending. That would be the best thing, by the way, for the economy. To goose the economy, reducing government spending and letting the private sector have more of the change would be the best policy. But you also can shrink a deficit by increasing taxes. Now that slows the down. So that's not so great. And this I'm talking about direct tax, what you pay on April 15th. You can also have another kind of tax to shrink the burden of the fiscal deficit and the debt to GDP, and that's what's called an inflation tax, and that's bad. So the two taxes are bad, and shrinking the government expenditures are good. So I'm on the shrinking government expenditures or slowing those down to close that deficit. The deficit is definitely bad. I don't see anyone on the political scene that's willing to do that. And if you look at the history of fiscal control, if you have statutory changes that are put in place, new fiscal rules that try to slow things down, those tend to work a little while and then they break. So the only way you really can do it, I think, is to have a constitutional convention under Article 5 of the Constitution and look specifically at how to change the Constitution that would require something like a Swiss debt break, like the Swiss do. They changed their constitution, and now they must balance their budget, and the government expenditures can't grow any more rapidly than the rate of growth in the economy. So that's that. I think that's the only long-term solution, really. You and I are in the same camp, obviously, on this score. These kinds of things aren't a problem until they sneak up and bite you in the rear end. It's that kind of problem. And President's Council of Economic Advisors under Nixon once said, if something can't go on, it will stop. And this can't go on, and it will stop. And what people have to think about are those three options that I just mentioned to you. Are we going to squeeze government spending? Are we going to increase taxes or direct taxes? Or are we going to have more inflation tax? That's the only thing that can happen. And it will happen, by the way, because as Stein says, if something can't go on, it will stop. The way we put it in was the problem, because we had a massive increase in government spending, a massive increase in the deficit, and the bonds that were being issued to finance that deficit were being bought by the Federal Reserve. About 90% of the deficit was being what they call monetized, Anthony. And that's why the money supply shot up. We would not have the inflation we had if that monetization of the fiscal deficit hadn't occurred. If those bonds had just been sold to the general public, we would not have had the kind of inflation that we experienced. So it was the Fed that was kind of basically in bed with the fiscal authorities, and that's where the nub of the problem is. It comes back to what I originally said. Money matters, money dominates. It's all about the money supply. With those who occupy Washington, D.C. and got us into the hypothetical crisis that you just put forward, it's very hard to predict what they would do. My guess is they would probably panic and make a move that maybe would make the crisis even worse. This is one thing in the markets. I mean, you're in the market every day, and the thing that amazes me is that the markets aren't pricing any of these kinds of things in at all. You and I are talking about the debt and the deficit and the CBO sustainable. We know the arithmetic just can't keep going like this. The markets just don't have anything priced in for that. The markets are not pricing any of these broad things in. For example, the proxy war the U.S. is engaged in with Russia right now in Ukraine. None of that's priced in. What's going on in the Middle East? None of that's priced in. They're just all these larger things that are kind of off beyond the horizon when they bite, but before biting, nothing is happening. None of that's priced in. No one's pricing in a bite. The actionable in terms of fiscal policies simply way out of equilibrium, shall we say. It's not sustainable. So I would start doing something with it right now. And as I say, what I would do is be pushing for a constitutional convention and a change in the Constitution that imposed something like the Swiss debt break into the U.S. Constitution. That would fix the fiscal thing right away. The next thing I would do is get a chairman of the Federal Reserve that was in there paying attention to what was going on with the money supply. Somebody like Paul Volcker, who paid attention to the money supply. It's all about the money supply. The current chairman, Powell, is not even looking at the money supply. They don't even look at it. They've poo-pooed the thing. They said it doesn't matter. It doesn't count. It's not in their models. It's not in any of their templates. They hardly even report on it. How many times do you see in the newspaper a headline of what just happened to the change in the money supply during the last month? You've got to look in some footnote, even in the Wall Street Journal, to find the number. Let's talk about the stock market for just a second to get my kind of perspective. The stock market, the S&P 500, it's up about 15% this year, and we've had over 30 record closes this year, and there's very little volatility in the market. This day is the trading range at plus 1%, minus 1%. The fear gauge, the Choi index, is below 12. That's the lowest it's been in 5 years. Now that's the price for options to hedge against a downturn in the stock market. The breadth of the market is actually very narrow. 10 stocks make up 37% of the market cap. And if you take those, if you just don't weight given market cap size of the stocks traded on the S&P 500, just a simple sum of those, the market actually would be down. The S&P 500 be down the last 30 days. So, and the volume's low. And as I say, no factoring in of any of these geopolitical things, no factoring in of what I think we will see a continued slowdown and a recession starting probably late this year, early next year, due to the fact that we've had this monetary contraction. We've got an inverted yield curve. We've got gross output. That's if you take all the sales, we've got gross output is all the sales between all intermediate, everything in the supply chain. And that is growing actually less than, at a slower rate than GDP, which is the measure for final goods and services in the economy. Now that's, all of these things are very negative. The market's very pricey. If you look at Robert Shiller's inflation adjusted PE and look at the data since 1881, we have 95% of the time PE, that inflation adjusted Shiller PE, has been less than the PE is right now. So the PE is, prices are strong. So what would I do? I'm a Buffett kind of guy. And Buffett's rule, when Buffett really piled into Apple, he said, I want to look for a stock that's trading, that's cheap, less than 15 as a PE. Well, the current PE is about a little north of 20, 21 in the stock market. So the market wouldn't qualify for the Buffett rule. Then Buffett said, I want a company that there's a 90% chance that the earnings will grow over the next 5 years. And the third element of Buffett's rule, he says, I want a 50% chance that the earnings would grow at least 7% year over year. Well, now how many companies qualify for the Buffett rule investment? Plus this overall picture I have of caution in there. The market's pretty toppy. So I would say hang on to your good stocks that are doing well and pay attention to things. And you're not going to find any stocks to buy that merit buying given the Buffett rule. There's essentially nothing to buy. And then also in your portfolio, since inflation's coming down, you want to be long the 10-year. The interest rate on the 10-year, when I was recommending going long the 10-year, the yield was about 5%. And I said, inflation's going to be coming down because the money supply is contracting. And with that, interest rates always follow inflation, Anthony. So if inflation's coming down, interest rates are going to be coming down on these long bonds. So enter the 10-year. I think it's a pretty safe bet. Keep your good stocks that are doing well and follow the Buffett rule about adding any new ones. And I don't think you're going to find many. For one thing, that petrodollar agreement, from what I can figure out, never existed. So this has been something that's been floating around on the social media, but as someone who's been studying currencies more or less for over 50 years, I'm not aware of that agreement. From what I can figure out, it never really existed. But be that as it may, what are the risks? Well, the risk, if you go back 2,500 years and look at all the currencies, there's the world economy for 2,500 years, there's always one dominant international currency. The US dollar happens to be the dominant international currency. There have only been 14, Anthony, in 2,500 years. So it's hard to knock the king off his throne. But how do you do that? When do challengers come in and knock a king off the throne? They come in with basically bad monetary management and bad economic policies of one sort or another. So let's look at the U.S. and the U.S. dollar. Right now, of course, it's unbelievably strong. It's been unbelievably strong for a couple of years. It's the old line as a trader, you'll know this and appreciate it. Buy dollars, wear diamonds. And so that's where we're at right now. If you look at the social media, you've got basically the enemies of the United States who want to de-dollarize. So they're fanning the flames, saying all these weaponization of the dollar, sanctions and so forth are going to cause the dollar to tank and somebody else will take over. Well, I agree. Sanctions are a bad thing, and weaponization of the dollar is something that makes it more vulnerable, but something to keep your eye on. But at this point, we're certainly not at any tipping point. So you have, China and Russia, they talk a lot about de-dollarization and the fact that the dollar is history. And of course, all the crypto crowds, they put out basically the same propaganda. So you get a lot of chatter about de-dollarization. But the fact is, if you look even for central bank reserve buying, central banks are piling into the dollar now. They're actually increasing their dollar reserves. The percentage of their total portfolios that has been in dollars, it has gone down a little bit in the last 10 years. But one of the main reasons for that is that the Swiss were intervening tremendously to try to hold down the value of the Swiss franc, which kept ever appreciating by doing what? They were buying euros. They were selling Swissy and buying euros. So if you look in the aggregate reserves of all the central banks, that's the reason the dollar's role looks like it was sliding a little bit. It was mainly that Swiss intervention. Now they're actually coming back into the market and buying dollars.